Sanjay, you were talking about the financial space. Outside of the banking lot, would you buy any of the NBFCs, either the power NBFCs which got a leg up from the Tamil Nadu State Electricity Board measure yesterday, or any of the beaten down gold finance companies? Anything in that lot which excites you?
I wouldn't touch the gold finance companies, that I'm very clear about, because it's a very narrow focused model, which is obviously we've seen open to regulatory scrutiny and action, concentrated issues, etc. So I wouldn't want to be there. In fact, some of the broader NBFCs make a lot of sense to me, which includes things like L&T Finance, Shriram Transport Finance, Sundaram Finance, Reliance Capital, one of my favorites always, and I'm long on it. Indiabulls Finance, because these kind of companies at least have a little broader based models, both geographically and in terms of product lines. And what I see happening this year is a good amount of unlocking that will happen in terms of insurance company fundraising and insurance company offerings, as well as strategic stakes. And most of these companies have exposures there to asset management as well as insurance companies. We've already seen some dilution in the insurance and the asset management companies or select companies. L&T Finance just picked up the Fidelity business. So I think these broader financial plays over the next 18 to 24 months look much more exciting than narrow focus plays, as we saw in the case of microfinance industry as well as the gold finance. Wherever concentrated positions are there in terms of businesses, in terms of geographical reach, you're bound to have problems, and those models are not sustainable, both in terms of in terms standing the test of time as a business as well as regulatory implications. So I would definitely prefer the larger NBFCs, because balance sheet size and a good spread is what is key there, in addition to the banking for companies.
How do you pick and choose between infrastructure now, Sanjay? I mean, not the frontline stocks, but outside the index. Anything that you prefer as either a story or a vertical?
Well, I think there are lots of companies there which are just waiting to turn into 2x, 3x over the next few years. They've been beaten down in the last 18 months. They've got very good capabilities at the grassroots levels to execute projects. We know the companies like L&T, etc., when they get projects, they're not able to execute them completely on their own. They do farm them out to some of the smaller companies, which eventually turn big over a period of time. We've seen so many of them grow up. Companies like IVRC are living examples, which are now being acquired, by some kind of hostile positioning is happening there. Similarly, there are many other such companies, second-round companies, which are worth a look at this point of time. Balance sheets are clean, there isn't much of debt, and I think as soon as the order flow starts picking up, the contracts start picking up, they will just multiples will change dramatically, because they've been beaten down to a great extent.
Would you still buy any of the fancied consumer names like the Batas, the Jubilant FoodWorks, the Titans of the world, or is your focus more on the beaten down lot where valuations are not so demanding?
Something like Titan I would put in a separate basket, because it's got a different positioning altogether. But whereas a Jubilant or whereas a Bata, etc., I wouldn't want to look at this point of time. Not that the companies won't do well over a long period of time; they have good business models. But right now, I would be opportunistic and look at some of the beaten down names which would bounce back much stronger once the rate cycle is going to turn, and credit availability and liquidity is going to be sorted out, as well as the order flow issues are going to be sorted out for these companies, whether they're in the capital goods space or the infrastructure space. I think there's going to be much more traction, both in terms of margin and top lines, and those are the companies which will give much better returns compared to some of these consumer plays. Yes, they are defensive. Over a period of 3-5 years, you may protect your portfolios, but as someone who's a little more active in the market, someone who's got is there in the market, I would take that kind of positioning. That may not be the case of a conservative investor, but at least for my kind of profile, I would want to be aggressive at this point of time in the beaten down names.
You were talking about oil, Sanjay, but what do you do with commodities like fertilizer and sugar? On fertilizer, apparently the word is that the urea policy may have been shifted back by as much as 3 years. I mean, they'll just work with retail price hikes now. On sugar as well, we haven't really heard anything in terms of policy changes. What about those kind of pockets?
Mithali, I've been quite clear on this, and I absolutely steer clear from all these companies who are completely dependent on government policy regulations. And in fact, that's the only reason why I like, one of the major reasons why I like the financial services sector and the NBFC sector, because it's least regulated. and it's got something which has got a perpetual demand in a growing economy like ours, both at the consumer and the industry level. Coming back to urea and those kind of things, anything that's dependent on government policy, anything that's dependent on politically sensitive issues, things like sugar, fertilizer, other agri-related imports and food imports, I think we'll perpetually be driven by government policies and the flip-flop that might hear every day in media. So therefore, as an investor, I wouldn't want them to be in my basket at this point of time, because I think it's a long time since we have clarity. We're a long time away till we have clarity on all these issues, because government is grappling with a lot of issues on the fiscal side to handle things like fertilizer subsidies, etc. So I want to stay away from anything that's dependent on government policy, which includes the oil marketing companies, even though they are beaten down. We've seen them beaten down for donkey's years, and having lost a lot of money, I just don't want to go there.
You're intrinsically an equity guy, Sanjay, but what would you tell investors to do on other asset classes as part of their asset allocation now? Because last 1 year people have been more in fixed income, more in fixed deposits, gold, which has not done very well in the last quarter but did very well last year. What would you tell people to do with some of these other non-equity asset classes now?
I would be underweight gold, I would be underweight debt at this point of time, but I'm not saying they shouldn't be in your portfolio. They should be intrinsically part of your portfolio. But I would be, overexposed, probably that's the wrong word, but I would be overweight equities at this point of time, because I think that's the play for the next 5 years in India. We've got too much negativity, we've got too much thrown at equities, but we missed some of the good things that have happened in the last 6 months also, besides all the negative things that are happening, whether it's the QFI direct entry into the markets, whether it's SEBI regulations becoming much better, more transparent, what we saw yesterday on listing of stock exchanges. There is a lot of work going on there at the regulation level, at the SEBI level, as well as the government level. They're trying to simplify things, but one must understand, we are after a democracy where it's going to be a hell of a lot of struggle. We'll have to live through many years to go through, to see these things going through. We have our own, fits and starts of doing things, and then we suddenly go to sleep. That's typical of what India has been all about in the last 2 decades. And I think one has to live through these periods. If you're a serious investor and want to make money, equity is the place to be, and whenever you see equities totally out of flavor, not in party talk, Udayan coming with a long face in the morning, Mitali agreeing with him, that's the time when you should go out and look at stocks. That's the time you should go and look at stocks and just quietly sit and hold it out for the next year or two. Yes, I've lost money, I've given wrong advice. I think probably 8 on 10 my advice has been good, but anyone who's held on to equities over a long period of time, good quality stocks, has made money.
What is this? Why do you come to work with a long face?
No. I would be the happiest and would smile the loudest if the market went on to a really trending bull run. Maybe Sanjay would be a bit happier.
Well, that's the problem. You shouldn't be smiling then. You should be trying to encourage people to hang in there, in these times.
I know. Sanjay, you tried for the last 2 years. Kya kare? Hang in there. Thank you as always for joining in. Yeah, that's true.
Ask me, yeah.
Thanks as always
Thank
for
you for
joining in.